Hello, this is Simon Klein speaking, and in this short video we're going to discuss how to trade the United States presidential election. Before we begin, a quick disclaimer. Please bear in mind that all comments made by myself are for educational purposes only, and as you all know, there is a high degree of risk involved in all types of trading. Now, before we begin, you all know that trading is a business. I always begin all of my webinars in this way, and likewise I'm going to begin this short video in this way as well. You must know that trading is a business, so treat it as a business. And hobbies cost money and businesses make money. So you must have a plan with your trading, a proven plan that makes you consistent money over time. If you do not have a plan, as the saying goes, if you fail to plan, then plan to fail. So what's our agenda for this video? We're going to discuss the US election, what you need to know about it. We're going to discuss the effect it may have on the markets. Then we'll talk about how to trade it. We'll go into a little detail about supply and demand and general trading the news. So, the US presidential election, what do you need to know? So the US presidential election is happening this week on November the 8th, 2016. It's the 58th quadrennial US presidential election. The term limit prevents Barack Obama from being elected to a third term. And the election will determine the 45th president and the 48th vice president of the United States. So what effect will the US election have on the markets? Well, guess what? No one knows. It's all speculation. Anything can happen. Volatility is likely to increase. You have to look into your risk management. Liquidity may decrease, and because of that there may be slippage in the market. For example, if you place a stop at a certain price, say you bought at 10 and you had your stop at 8, and the market starts moving very quickly and it hits your stop at 8, you may not get filled until the market maybe go down to 4 or below, because most stop orders are stop market orders. Once that price is hit, it says get me out at market, and if the market keeps moving, there's likely to be slippage. So you have to bear that in mind. As we just said, stops may not be effective. You may have a stop in a certain place but not get filled at that price. You may end up losing double what you wanted to lose. So therefore you have to look into position sizing. Make sure that if you are trading the news, you have to bear in mind that there could be slippage and position size accordingly, so you don't risk more money on any particular trade than your account can manage. If you're in long-term positions, you may want to hedge your risk before the event. And you should also know that the market may actually move beforehand. The election's happening on November the 8th. The market might make its move in anticipation of the results of the election. So these are the effects that may happen in the market. So once you know that, how do you trade it? Well, here's one approach. Do not trade it at all. Deciding to not trade is also a trade. So you may decide, I'm not going to trade the election. It's not a regular event that's happening in the market, and I don't have experience trading it. Therefore, I decide not to trade it. Or you can decide you're going to trade it. Whatever you decide, but have a plan, as we said before. Make sure your account is well funded. And you should trade it like any other news event, and more on that later. Also, if you are trading it, you could trade it with a smaller size or smaller position size so that a big move against you will not wipe your account out. There was also a potential gap risk. The market can just gap up or down depending on what market you're trading. If you're trading the Forex market, the foreign exchange market, gaps generally happen over the weekend where there is a stop in trading and a build-up of orders on the buy or sell side causes gaps. In the stock market, gaps can happen every single day because it's not a continuous 24-hour market. So there could be orders built up on the buy side or sell side before the market opens at 9:30 a.m. Eastern time in the US, if you're trading the US stock market, for example. As we said before, there could be slippage as well. So you have to bear in mind when you're position sizing that you could end up risking more than what you wanted to risk because stops may not be effective at the price because of slippage. So here's an approach that you can take to trading the news. If you can understand what supply and demand is and how that affects the market, then you can use this to actually trade almost any news event, and you can actually use this to trade generally, which is what I do with my trading. So what is the relationship between supply and demand? So everyone knows if demand is greater than supply, then prices will move higher. There's more willing buy orders in the market than sell orders. Prices will always move higher. And the other way around, if there's more supply than demand, prices are likely to fall. And the final scenario is when markets move sideways, when supply and demand are in equilibrium. When there is an equal number of willing buy orders and sell orders at a certain price level in the market generally goes sideways. So let me ask you guys a question and think to yourselves. I'll give you a couple of seconds to think about it. So what actually moves the market? You can type a comment below this video. What moves the market? Guess what? The imbalance or the relationship between supply and demand is what moves the market. As we said before, if there's more demand than supply, prices move higher. And likewise, if there's more supply than demand, prices will move lower. And if supply and demand are in equilibrium, then prices move sideways. So the question is, what causes those imbalances? And does it really matter for me as a trader? Well, if you can see imbalance in the market and you can spot those supply and demand levels ahead of time, then price is generally going to move in those areas, are going to turn to the up or downside. What causes that? That's an interesting question. Does it really matter? We're trading what is happening. We don't really need to know why, even though you could combine them if you combine fundamental and technical analysis together and try and understand what causes those imbalances between supply and demand. But as a trader, you can just focus on the what is the market doing as opposed to why. It's a very dangerous question to ask when you're trading. Why is this happening? Good news comes out. I bought. It's going down. Why? That's a dangerous question to ask. What's happening? It's going down against me. What should I do? I have a stop in place. If it hits a stop, I get out. I don't pull the stop out and start to increase my position because I believe the market's going to go higher based on the good news. Because what may happen is it continues to go down. And if you don't manage your risk, you could end up with a big losing trade and potentially wipe your whole account out, which has happened to many people in their trading careers. You do not want this to happen. So it's very important to see what is happening, to trade what is happening in the marketplace, in the charts. More so than understanding why. Why you can ask afterwards. The news always reports why something happens afterwards. They're never going to tell you beforehand the news is going to be good for the dollar and the dollar's going to go higher, or Brexit's going to be bad for the dollar, for the pound, and the pound's going to go down. You only know that after the event, how the market reacts to the news. And guess what? Once you understand the relationship between supply and demand, you know this will never change. This is a fundamental belief of how supply and demand affect prices of anything. This will never ever change. So if you build your trading philosophy based on sound principles of supply and demand, you will not need to change your understanding or your belief system about how the market moves, because this will never change. This is a way the market moves now. It's the way the market has always moved and will always move. So your only job as a trader now is to identify where supply and demand imbalances are on the chart, because those are those high probability areas on the chart. Remember I said areas or zones. They're not exact prices. They're zones where there are imbalances between supply and demand. Those areas in the chart is where highly likely the market is going to turn to the up or down side. Those areas are where the trend is likely to come to an end. As the saying goes, a trend is your friend until the bend in the end. That bend in the end is those areas of imbalance between supply and demand, where there's more willing buy orders and sell orders, which is likely where a downtrend comes to an end. And when there's more willing sell orders and buy orders, that's likely where an uptrend will come to an end. So take this information forward now. How do you trade the news? Any news, not just the US presidential election. So firstly, you need to know when news events are happening. You need a timetable. So we know that the United States presidential election is happening on November the 8th. But the results won't come out likely until November the 9th. So we're going to have a couple of days and maybe a day before where the markets could be volatile. The move could happen before, it could happen during, it could happen after. So what you need to do is be prepared ahead of time. You cannot trade if you're not prepared. Preparation equals confidence. Confidence means you're not going to trade with fear. If you trade with fear, you generally do the wrong thing. You want to make sure that you're trading your trading plan. So you must have a trading plan. So let me ask you guys a question again. Does news move the markets? So think about your answer now over the next 3 or 4 seconds. Does news move the markets? Now the answer to that question is no. For all those who said yes, listen carefully and I'll explain. Say for example, we have a pharmaceutical company. And the pharmaceutical company discovers a cure for cancer. It's one pill, it costs $100, you take it once and cancer is gone. That pharmaceutical company is called ABC Pharmaceuticals. They're trading on the New York Stock Exchange. It is now Sunday afternoon. What is happening to the price of ABC stock? Guess what? The market is closed. It's Sunday afternoon. Nothing's happening to it. So, did the news move the market? Well, good news comes out for ABC Pharmaceuticals, and the market is not moving. Therefore, you can come to the conclusion that the news does not move the market. So what does move the market? It's people's reaction to the news. And guess what? People are going to react to the news, but the market is closed. Therefore, the reaction to the news is going to be delayed until the market actually opens on Monday morning, whereby it would be quite common in this scenario for the market to gap up to where there are willing sellers. Because if everyone in the world wanted to buy on the good news, there must be someone on the other side of the trade to sell to them. The market will gap up to an area where there's willing sellers. What may happen after that, after all the buyers are absorbed and there's still willing sellers, for example, therefore you might be in a situation now where there's more supply than demand and the market may sell off for the rest of the day. That could be a scenario. So sometimes if you buy on the good news, you might end up in a negative situation immediately after you buy, because once you bought, you may buy high and the rest of the day it may sell off. So just because there's good news does not mean that you're going to be entering at the best price. It may go up, later on in the week, for example, and continue higher, or may not. But you want to time your entries correctly. So understand now that news does not move the market. It's people's reaction to the news that moves the market. And as we say, we do not trade the news. We trade the reaction to the news. So how can you trade the news? So say, for example, the market looks like this before the news. If you can identify areas of demand and areas of supply in the market, like over here, and the market's like this before or during the news, so what do most people do? So good news comes out, say on ABC Pharmaceuticals, and the market gaps up here on Monday morning into a supply area. Now, once the last buyer has bought and there's still more willing sellers here, we're in a situation where there's more supply than demand, and the market is going to drop. Likewise, what the market could do on the news is it could initially drop to demand where there's willing buyers and go up. It could do anything. It could, stay the same. Anything can happen. But what you do need to know is, objectively speaking, probabilistically speaking, once you can identify supply and demand, there's more willing sellers here than buyers because the price dropped from this area, and likewise more willing buyers here than sellers. So it's probabilistically, it's probable, or highly probable, that price will rise when it moves into an area of more willing buyers and sellers. So many times you guys might have done this on the news. Bad news comes out, and I'll give you another scenario. Bad news comes out, and you hit the sell button on the news. You get filled here. It's a market order that you click. Sell me, the news is bad. You get filled here, and the rest of the day it goes all the way up here. And you're like, what just happened? I just sold on the bad news. Why is it going up? Well, guess what? After the last seller sold, and there's no more willing sellers, and there's still more willing buyers and sellers, prices will rise. So an approach that you can have to trading the news is this. If you can identify these areas of supply and demand, again, it's beyond the scope of this small video, then what you want to really be doing is buying in areas of demand. You may want to put your stop below the demand zone, for example, and selling in areas of supply. That is usually the best approach to trading the news. Objectively speaking, with a high probability, you're going to be buying after the markets move down into a demand zone, and selling after the markets moved up in a supply zone. Of course, there's much more that needs to go into trading than this, but this is just a beginning to how you can actually approach trading the news. Obviously, you need to look into risk management, where you're going to place your stop, where you're going to place your target, how you're going to manage your trade, many different factors that go into trading. You need to have a trading plan. You need to have a strategy in that plan. You need to know exactly what you're doing. It needs to be a proven strategy that you've proven makes you money over time. It needs to have a positive expectancy. Not every trade is going to work. But over time, if you have a positive expectancy, you will make money. So that's all I wanted to cover with you now, of how you could possibly approach trading the US presidential election. If you liked this video, hit the like button below, share it with your friends, and be sure to subscribe at the end. That's all for now. This is Simon Klein from TradeSmart. Good luck with your trading.